Hey everyone, me Kevin here. We've just heard about a complete debacle that has started around Tuesday of last week and has lasted until today, and it has to do with hedge fund greed, margin, the collapse of loans after a margin call, and a complete disaster in the hedge fund market that has been echoing throughout, well, the stock market even today. Not only have we seen many shares sell off last week, but shares have been selling off today, and people are wondering, wait a second, what the heck is happening? Is what just happened with this hedge fund potentially going to happen again, or other companies at risk? Should we just sell and get the heck out of this disaster? Is this really a once-in-a-decade margin call, or is that just a nice way of making us feel good until the real crap hits the fan? Well, in this video, I'm going to break down exactly what the heck just happened over the last week so you can fully understand what's going on, why it happened, and whether or not we expect that it will happen again or not. All right, here we go. So first things first, you gotta know about this guy, Bill Hwang. He founded an offshoot of a successful fund called the Tiger Fund in America, and he founded this in Asia, and eventually he managed over $5 billion of money in this offshoot of the Tiger Fund. However, they kind of got screwed in 2008 when the Volkswagen short squeeze was happening, and after a few years they decided, you know what, we're going to shut down the Tiger Fund in Asia. Bill Hwang was the leader of the Tiger Fund in Asia, so it's kind of like the GameStop squeeze, but except it was Volkswagen back then. That really hurt them. So in 2012, and I'm really condensing the history, right? Because it doesn't matter so terribly much, but we're going to get through this. So in 2012, they decided, you know what? We just don't want to be a regulated hedge fund anymore. Let's just give everyone their money back who invested in our hedge fund. And, there's some charges that maybe we, did some insider trading to make some money. And let's just plead guilty, pay a $44 million slap on the wrist fine, and take our company private so we don't have to deal with the freaking regulators as much anymore because the regulators are up our... Yeah, so that's exactly what Bill Hwang did. He went private, and this was very common over the last decade. We saw a lot of hedge funds go from being hedge funds, which are much more regulated by the SEC, to basically just being private family funds. And see, family funds only really work with direct family assets. So you actually have to kind of map out a family tree and go, see, we're all connected somehow, all the people who are investing in this, and because we're all connected, we're good. We don't have to disclose as much. That's one of the big benefits of being a family fund, is you just get to hide from regulators a little bit more, because you see, the Security and Exchange Commission cares not whether or not what you are selling is good, they just care that what you are selling is honest to the public. But if you're selling to people within your family, they don't really care as much, because if you want to screw your family, I guess that's on you. And that's kind of exactly what happened here. Except Mr. William, decided to call this fund Archego. And Archego now managed about $10 billion in assets, which this sounds like a family that I kind of want to be able to say I'm a part of, because I want a part of that 10 bill, but I don't want to be a part of the shadiness, and that's what we're going to get into. Here's the shadiness. I'm just saying, family with 10 bill, there's enough money to go around when you got a family with 10 bill, okay? That's a lot of money. But anyway, so here's apparently what happened. So Mr. Bill had about $10 billion in assets, roughly. That's what we know right now. It could honestly have been much less. And Mr. Bill decided to get involved in a very common hedge fund tool known as total return swaps. Sometimes these, by the way, are also called total rate of return swaps, and that's going to make sense in a moment, or cash-settled equity swaps. I actually personally think the easiest way to remember what these swaps are is just think total rate of return swap. That's really, really useful, and it'll make a lot of sense when we go through the example, because literally what you're doing is you're swapping rates of returns with somebody. And the reason I say I like the total rate of return swap is I kind of think about it like this. Let's say I agreed to pay somebody 4% interest, but then they made 15% on a certain stock, let's say. I could take those interest rates and swap them. I'm like, give me the 15%, you just keep the interest rate. Now, the same works in reverse, which could be dangerous as well. And so we'll talk about this example, but total rate of return swap will help you keep this a little bit straight because it gets a little funky, and then you're going to get to see exactly kind of what happened here, okay? So best thing to do now is just go right into an example and show you how these things break down. So the easiest thing to do is pop open a nice little iPad sheet here, and of course remind you to get yourself 2 free stocks with Webull. Deposit $100 with Webull, get 2 free stocks worth up to $1,850. And if you want to earn interest on your cryptocurrency, go to metkevin.com/BF, or BlockFi is the company, metkevin.com/BF. Get up to $250 when you deposit money there, and get up to $25 when you deposit money at Voyager. Go to metkevin.com/Voyager. Quite frankly, I recommend diversifying, so just get yourself free money at all of them. And if any of it stresses you out, get life insurance by going to metkevin.com/life. You can sign up in as little as 5 minutes. Okay, pitch over. All right, so here's how this works. Archegos says, hey, we've got $10 billion in cash. We want to purchase a swap from you. And the cool thing about swaps is, because we're a hedge fund and because we're risky people, we want to take on a lot of leverage. We want our $10 billion to really control like $30 billion of money, because, whoa, if we make a 10% return on $30 billion, that's like making $3 billion in profit, versus if we only used our own money, we would only have $1 billion in profit. Yeah, leverage, yeah. Oh, but wait, leverage works both ways, so it's not always as simple or as ideal as it seems. So what happens? Here is exactly how a swap works. And remember how I talked about that rate of return swap, okay? That's gonna be really fun here. And so what happens here is Archegos says, hey, you know what? Why don't we pay you 3% interest on top of what your cost of capital is, which might be, let's say, LIBOR at 0.28%, which those are just standard things. Like, you could look up, what's the 1-year LIBOR today? Okay, it's just a basic cost capital thing that banks use. Don't get caught up in that. Basically, Archegos is saying, hey, we're gonna pay you 3.28% interest, and what we want you to do is we want you to take our $10 billion as collateral, and we want you to go buy $30 billion of, let's say, Viacom, because we're really bullish on Viacom. And the banks, Credit Suisse, Deutsche Bank, Goldman, they're like, okay, yeah, sounds good. We get to make 3%, and if your stocks go down, you pay us. If they go up, no problem. Like, you pay either way is the theory. So the bank is kind of like, cool, we're making 3.28%, and the goal is we really have little risk, because if the value falls, we'll just call you up and do a margin call. That's the theory. So the bank's like, cool, we'll make interest, and Archegos like, cool, we'll get to leverage up our money. This is actually really, really common, happens all the freaking time. And so the way this would work is just like this. Let's draw a little line here, and the easiest way to understand this is just via a simple example. Let's take that $30 billion, and let's say the market goes up 20%. So all of a sudden, that $30 billion creates a 20% return, which equals $6 billion of a return. Well, over here, you've got that 3.28% in interest. So take $30 billion times 3.28% in interest. Let's say it took a year. That's $984 million, and that represents 3.28%. So this was a positive swap in this case, because in this case, Archegos says, sweet, we have a swap contract, so please swap these returns. Bank, you get the 3.28% payment. In other words, you get the $984 million. And we get the $6 billion. Thank you very much. So we paid our fee for the $6 billion. We got our $6 billion. It cost us $984 million. Great, awesome, very, very profitable trade. And that's exactly how these swaps work. But what if the opposite happens and it's even more extreme? So let's say the opposite happens. So now we've got $30 billion at Viacom, but all of a sudden the stock goes down 40% to the minus. Well, crap, that's minus $12 billion. Now, technically over here on $30 billion, the interest payments were still that $984 million. But the banks are like, okay, we need to swap here. Let's do our swap. We get the 984 mil. You guys got to eat the $12 billion in losses here because the stock went down. And now we're going to perform the swap. Negative 12 billion. The bank gets the 984 million. That's how it's supposed to work when things go bad. But wait a minute. Big problem. Archegos only has $10 billion. So they are upside down. they get a margin call because the banks are like, yo, your stocks are plummeting. You guys need to come up with capital. Archegos like, yeah, we don't have enough to cover how much that just went down. And Goldman, Deutsche Bank, Credit Suisse are like, fine, sell Viacom. And so they just batch sell or bulk sell these shares at a discount to try to get rid of them to protect themselves from further losses. Okay, but that's just an example, right? This is just a hypothetical example. Yes, this is true. This is just a hypothetical example. But guess what happened in the market over the last few weeks? Stocks have been pretty volatile, especially certain Asian stocks like Baidu, or even other companies like NIO has been pretty rough too. But this particular fund invested in companies like Tencent and Baidu, which have both been feeling the burn lately. On top of that, they were investing in Viacom, which is a stock that has returned over 600% in the past year. It's been pretty incredible until, of course, they decided to raise some money, sell some stock, and that led the company's price or stock price or share price to fall dramatically and suddenly fell maybe 27.9% or something like that, in addition to all of the other falling values that this fund has been dealing with, leading the banks to say, yo, you're running out of money, margin call time, homie. And all of a sudden, what happens? They run out of money. The banks are like, that's it. We're going to batch sell these shares, and the shares fall even further. So that's an example turned reality. Archego took around $10 billion in assets, leveraged them up to $30 billion. When the swap went ugly, they didn't have enough money to cover it. And there wasn't enough disclosure for society or the SEC to actually even know what the heck was going on because they're a family fund that kind of, in the background, in a shadow way, got more than 10% stakes in some of these companies that sold off massively because they weren't technically holding the shares. The banks were technically holding the shares. And so that's how they got screwed. Now, what are the risk factors here? Because look, Credit Suisse just lost $2 billion. Nomura, another fund, they're losing a lot of money as well because they were involved on the other side of this swap. Goldman Sachs says that their losses are immaterial, and Deutsche Bank liquidated early. One of the other issues, by the way, is apparently multiple of these banks were looking at Archegos' collateral, and they're like, oh, you got 10 bills? Sure, we'll lend you this much basically in a swap. And they were all kind of referring to the same original 10 bill. So it's possible that maybe that 10 bill was leveraged up way more than normal, or maybe they actually had less than we thought they had, and they were able to leverage that up way more than normal. So there's a whole big issue of transparency here. And in some sense, it's kind of like, how's the dude at Goldman supposed to know that the guy also securitized that cash collateral they had at a different bank? It's hard to know because the system's not really transparent, right? It's a disaster. Anyway, so now we kind of know what happened. Now we got to ask ourselves, what is the risk of this actually happening again? Is this the beginning of the end, so to speak? Well, look, this could totally happen again. This stuff is super normal. This is the same kind of crap that happened, almost the same kind of crap that happened in 2008. Except in 2008, it was credit default swaps and mortgages. So when the values of mortgages went down, all these swaps got obliterated because all of a sudden, like a $10 trillion mortgage market was leveraged up, not 3 times like in this Archegos case, but instead it was leveraged up 9 times till a $90 trillion market. It was a massive balloon, a massive bubble that got popped instantly. So what is the risk going forward? Well, I mean, the reality is the hedge funds are being their classic selves. They oftentimes are reckless suits who are over-leveraged, overly competitive, and poorly regulated people because of all these shadow and toxic and arcane products that exist with massive incentives for short-term profits that ends up meaning when they get hurt, everybody else ends up getting screwed and holding the bag because the hedgies and all these people doing these short-term massive whale trades on mass leverage don't give a crap other than trying to make whale trades and becoming a somebody by making big bucks when they get lucky one time. But when it goes bad real fast. This is exactly why people like Warren Buffett say, don't get into big leverage. This is exactly why I say, look, if you're going to even touch leverage, keep it under 20%. Folks, 20%. So for every dollar, you have maybe 10 to 20 cents. or keep it at zero ideally. Then you don't have to worry at all. Then you don't lose sleep at night. But these folks, for every dollar they have, they're at like $3 to $4 of leverage. It's ridiculous. That's how, when all of a sudden you turn on CNBC or whatever and the suits are up there going, yeah, we're rotating into this sector. They're doing that because every dollar they can pump up a stock is like $3 or $4 in their pocket. It's massive leverage. And there's no surprise that these weenie baby hedge funds are constantly rebalancing money and constantly getting margin called because they're all so close to the brink all the time because money is so freaking cheap. Everybody is borrowing more and more and more money, and it's really dangerous. Now, do we think that more of this is going to happen because of this? Like, are we going to end up having like, an after effect or aftershocks throughout the rest of the system because of this? Probably not. Probably not. If there were going to be more dominoes that would have fallen over, they would have fallen over by now. Mostly because we've already had basically Credit Suisse and the banks say, look, we've absorbed the loss. It's over. Let's move on. Now, that doesn't mean there aren't more Archegos or Archegoses out there. Totally possible that there are more of them out there. In fact, you can pretty much almost guarantee that there are. And that's just in the family hedge fund business, right? Or they're not really hedge funds, but the family fund business. Like, hedge funds do this stuff regularly too. Now, they have to be a little bit more transparent, but so what? Even if they disclose their holdings, it doesn't necessarily mean anybody's actually worried about it until poopy hits the fan. So, yeah, markets are very, very fragile. And the reason they are so fragile is oftentimes because of leverage. So keep yourself safe. Stay in as little leveraged of a position as possible. Ideally, you get to zero leverage on stocks. Ideally, you're at 65%, no more than 65% leverage on your real estate that is ideally cash flowing. And you could just continue investing for the long run and watch all these weenie babies lose their freaking minds. And you could just go, buy the dip. Thanks, y'all. Thanks for watching. If you found this helpful, consider sharing the video. And folks, we'll see you in the next one.